Hello class, so here we are, chapter 4. We're going to do a review, explanation of some of the things that are excluded from gross income. And then we're going to talk about the deductions for AGI, the most important or the most advantageous deductions in the tax law because they reduce AGI. So let's get started here. So here are some things that are excluded specifically in the tax law. Remember, everything is included in gross income unless specifically excluded by law. Gifts and inheritances, there's an exclusion for income that is earned outside the United States if you live there a sufficient amount of time. Certain fringe benefits, life insurance policies, okay, scholarship, and as long as you are degree seeking and fellowship grants. Municipal interest, tax-exempt interest, that's by state and local government, school districts, that sort of thing. They pay interest on their bonds, and that is excluded. Certain payments for injury and sickness, earnings on your IRA, that includes Roth IRAs and regular IRAs, any earnings during the time that it is in the IRA account, you do not have include any of that. Earnings from any of the 521's educational savings and certain discharges of indebtedness that are excluded specifically under the law. So let's look at how they work. First of all, this earned income exclusion, foreign earned income. Notice that you have to be physically present in the foreign country 330 days. So we're talking counting days now. Okay, so they're pretty serious. If they just are there the entire year, then obviously that's going to count. This does not necessarily have to be in one particular 12 calendar year period. It could be, they could qualify for this by being there the last 6 months of 2017 and the first 6 months of 2018. Something like that, okay? So it just needs to be some 12-month period that you are in that foreign country, 330 of those days. And then you prorate based on if you're not there the whole time. So if you're there for a 340 days out of 365, you only get 340 365ths of the 103,900. So a little example here. Okay, we got her 337 days during that period of time. Notice it goes over 2 calendar years. Their income is $52,000 in 2018. All right, so how much can she exclude? You take the 176 days. Again, we're counting up days from the end of July 9th through December 31st. Divided by 365 times the 103 equals 50,100 out of the 52,000. So obviously you can't exclude more than the 52,000. So if this number was higher than this, then you would choose that one. All right, so 50,100. $1,900 over foreign earned income would be taxed. So that's still something that she's going to pay tax on twice, assuming she pays tax on it in the other country as well. All right, fringe benefits. These are things that employers provide to employees, often in the form of non-cash, certain perks or things like that that happen because you work for a company. Usually the most common one, or the one that you probably hear most talk about, is health insurance, where the employer pays part or all of that. That money that the employer pays the insurance company on your behalf is not income to you as long as it is done appropriately. Okay? So you don't have to pay for it yourself, and that is technically a benefit. So these are some of the others, okay, that have to do with fringe benefits specifically mentioned in the tax law. As being qualified. Okay, so something important about fringe benefit is that discrimination rules apply to most of these, which means You can't pick and choose your employees or have a different kind of benefit for the high paid employees than you do with the lower paid. If you give everybody the ability, give some people the ability to use the copy machine without paying for it, you have to give it to everyone. Okay, those are the kinds of things that we're talking about. So if you don't, if you discriminate, then you end up with tax consequences to the highly paid employees. So if it's identical, then the fringe benefit is not subject to discrimination rule, and the fringe benefit is subject to the discrimination rule, but the plan does not favor key or file. It wouldn't favor if it was identical for all employees. That is, fringe benefit is taxable only to favored employees, so it never is taxable to the rank and file or the regular employees. The issue is only with the favored employees to the highly paid or key employees. If they favored, and the discrimination rule applies. The only two that doesn't apply: working condition fringe benefits and de minimis fringe benefits. These are the only ones that don't have a discrimination rule. Everything else, you have to give basically the same deal for everybody, or you're going to end up with a taxable consequence. All right, let's look at these two. Accident and health insurance, since this is common. Okay. So if your company pays $9,000 for each of his employees, that's not discriminate because everyone's the same. All right. So every employee excludes it. If they just violate discrimination rule, meaning that they favor, meaning for each of the employees, but let's say, for instance, the people that are highly paid less than those others, some way or another, then all key and highly paid employees pay tax or include that $9,000 in their income. Life insurance. Now, this group term life insurance is very common. Most employers provide this. They can provide up to $50,000 without including premiums and income. More than $50,000, then you pay for the difference, or there is a taxable income included in your income for the difference. This discrimination rule does apply, so you have to offer, if you're going to offer it for highly paid employees, you have to offer it for everyone. So this is the way you calculate the value of what the life insurance you're providing. This is per month per $1,000. So $30,000 of excess coverage would be 30 times this times 12, so because it's 12 months a year, based on the age of the employee. All right, remember, it's only the excess of 50,000. So 60,000 for each of employees does not discriminate. So Greg and Jeffrey both get this benefit. Greg is 42, so we calculate his using the 10 cents per month. All right. So he includes $12 of gross income. That's the 10,000 extra. 60,000 over 50,000 divided by 1,000. So that's $10,000 increments. Okay, times 10 cents per month times 12 months, like we talked about. Jeff is 51, so the only thing we do differently is go down to a different line, include more because his is more valuable. So his is 23 cents per month times 12 times it's 10 because of 10,000 over the 50. So if you discriminate, you provide more for your higher paid employees, then you either use the employee's full insurance coverage or the actual premiums. So that's even the $50,000, okay, becomes taxable to the favored employees. Non-favored stays with just the excess. tax-exempt interest, municipal bond interest. We can exclude interest on Series E and I. This is savings bonds, federal savings bonds, if they're used to pay qualified educational expenses. These will become less popular because there are better ways to save for your college, Section 529 plans and other things that we will see a little later. But there's still this availability, but you have to include some of it if you don't use all of what your proceeds. So you take your interest exclusion is calculated by taking interest including the proceeds. So bonds are turned in, you get the whole amount, and then the qualifying expenses as far as tuition and books that you didn't use some other credit for, divided by the redemption proceeds. So the best way to look at that is an example. Erin pays $12,000. Okay, she cashed in a Series E bond, savings bond. She received $15,000, 10 principal, 5 interest. Okay, so first exclusion is $4,000. You take the $5,000 of interest. We're not worried about the $10,000 at all. Okay, we take the 12, which is the total expenses, divided by the total we got. So we're spending about 75%. Or 80%, I should say, of what we got on expenses. That means we can exclude $4,000 or 80% of the interest out of the $5,000. Now, this has even got more caveat, and that is once you've got that number, you have to look at your AGI to see if all of it can be used. Because if you're over the threshold, you're going to have to further reduce your interest exclusion. So we now know Erin's AGI. Okay, so her $4,000 we calculated earlier must be reduced by $667 because she's $2,500 past the threshold. Divide that by the $15,000 and then multiply it by the $4,000. That's how much is reduced. So our ending exclusion is actually only $3,333. Means she's going to include, because she got $5,000, she excludes $333. She has to include $1,667 in her income. Compensation for physical injuries and sickness most of the time is not included. Workers' comp is always excluded. All right. If your employer pays for a plan and they pay you when you're sick, then that is excluded. All right. That's true even down to the things like Aflac that pays you a certain amount for every day you miss, as long as the employer pays for it. I mean, as well as you pay for it. Okay. If the employer pays for this last one, okay, then you have it as income. Now, anything other than medical expenses are paid for by the employer becomes taxable. Punitive damages. So if you sue somebody and they do what's punitive damages, those damages that are to punish the person. It's not to pay you back for your suffering, but to punish them. That is taxable. The amount to reimburse you for your sickness or injury is not. Non-physical injuries such as discrimination or something like that are taxable awards because they're non-physical. The only part that could be excluded is anything that is, let's say you got discriminated against and then you went and saw a counselor and actually received counseling because you had depression based on the discrimination. That would be an actual physical diagnosis, and therefore the payments for that would not, if they reimbursed you for those payments, that would not be included in income. But for the most part, non-physical injuries are compensation is included in your income. All right, let's stop there. We'll come back in part 2 and talk about Roth IRAs and some other deductions for AGI.